Hi, I'm Grant Steven.
And I'm Kris Bernier.
And we're the two investment guys. This week, Kris and I want to talk a little bit about what the market seems to move to next. Now, this would be post-U.S. election. We were looking for some clarity around who the president would be and who would win the Senate and the Congress, and we've got that, Kris, and I'm not really sure that we've solved anything other than we know President Obama's in for another 4 years. Doesn't take the capital markets too long to focus on the next issue, which you're probably hearing a lot about, and it's one that's called the fiscal cliff. We thought we'd talk about it a little bit today, what it is, what it means, and what some of the expectations are around that, Kris. So why don't we kick it off with what is the fiscal cliff?
Sure. Well, the last time the U.S. government got to talking about raising the debt ceiling, they compromised and pushed some of these issues further into the future, which happens to be the end of this year. They're now calling this the fiscal cliff, and it's a combination of tax increases, payroll tax increases, and mandated spending cuts. Now, if all of this were to be implemented all at once, it would accumulate to a total of about $600 billion. And that would be a fairly big hit to the economy. There's fear that if this does occur, that it could push the U.S. into recession. And with the status quo being maintained in with the Congress and the Senate, there has been dysfunction in the past, and so there's some concern that they won't come to any kind of an agreement.
Right. So that's what the capital markets look at. If they're looking for improvement in the legislative process, the jury's out really on whether we're going to get that. Mm-hmm. And make no mistake, a $600 billion potential drag to U.S. GDP is very significant at a point in time where the economy is just starting to put some of the pieces of the puzzle together. I think that could seriously, it has the potential anyway, to sideswipe the recovery. It's pretty apparent that the lawmakers in the U.S. don't want this to happen. We believe that maybe they take it to the 11th hour again, but there will be some compromise. The Republicans will have to probably go along with some tax increases. The Democrats are going to have to go along with some spending cuts. In the final analysis, it'll be a combination of those things in order to push this situation through.
Yeah, I think it's very clear, at least to the lawmakers, that they don't want a repeat of what happened last time. There's a lot of pressure on them to get something done, and we believe they will. Particularly, as you pointed out, it's coming at a time when the economy in the U.S. in particular is starting to show some signs of steady improvement, with the housing sector improving. GDP numbers in the last quarter were higher than expected. Employment increases are moving along in the right direction. So they certainly don't want to derail that aspect of the economy.
Kris, what does it mean in markets day to day? Well, probably some volatility until we get to the compromise. Markets are going to seesaw back and forth. They don't like clarity or lack of clarity or uncertainty or anything like that. So our expectation is until this is resolved the end of December, it's quite likely that we'll have elevated levels of volatility again in the markets.
That's right. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. We're going to continue our discussion around capital markets and give you an update on some of the earnings that we see. So until then, I'm Grant.
And I'm Kris.
And we're the two investment guys.